When war breaks out, most people panic. Markets crash, headlines turn red, and investors rush to sell. But smart investors do the opposite. During major conflicts, certain assets don't just survive, they explode in value. Gold surges, energy prices spike, defense companies grow rapidly, and the investors who understand this shift often protect their wealth while everyone else is losing money. So where exactly do smart Americans move their money during war? Global conflict erupts. The first reaction across the world is uncertainty. Governments mobilize resources. Supply chains begin to shift. And global markets start reacting almost instantly. Throughout history, wars have triggered dramatic changes in the global economy. Investors watch carefully as geopolitical tensions rise. Because every major conflict sends signals about where money might flow next. During periods of uncertainty, markets soften and experience volatility as traders and institutions reassess risk. This is why the early stages of conflict often create sharp reactions in financial markets. But while many investors panic during these moments, experienced investors understand something important. War doesn't just create destruction. It also creates economic shifts. And those shifts often reveal where capital is quietly moving. When uncertainty spreads, financial markets often react dramatically. Stock markets can fall rapidly as investors move money away from risk. Traders watching global news channels begin reacting within seconds of major geopolitical developments. Institutional investors analyze how supply chains, energy markets, and government policies may be affected. This leads to rapid adjustments in portfolios across the world. But not all sectors react the same way. Some industries struggle during conflict. Others begin to rise. Understanding this difference is what separates emotional investing from strategic investing. Because during global crises, money doesn't disappear. It simply moves. Modern economies depend heavily on global supply chains. Ships transport oil, metals, food, and technology components across continents every single day. But during wartime, these supply routes can become uncertain. Sanctions, military blockades, and geopolitical tensions can suddenly disrupt global trade. When that happens, prices begin to react quickly. Energy prices may surge. Commodity markets may tighten. And industries dependent on global logistics can face sudden challenges. These disruptions create both risks and opportunities in financial markets. And understanding these shifts is critical for investors trying to navigate uncertain times. When uncertainty rises, investors often search for stability. And throughout centuries of financial history, gold has long been considered a safe haven during economic turmoil. Because of this, investors often move part of their wealth into gold when markets become unpredictable. Central banks themselves hold large reserves of gold to help stabilize financial systems. This is why gold prices often rise when geopolitical risks increase. Instead, they diversify their portfolios to protect against uncertainty. By allocating a portion of wealth into gold or gold-related investments, some investors buy physical gold. Either way, the objective remains the same: preserve purchasing power during uncertain times. Stock markets tend to outperform safe assets. But during crises, the situation can sometimes reverse. Understanding these patterns helps investors build more resilient portfolios. Defensive assets provide stability during turbulent periods. During uncertain times, investors closely analyze historical trends to understand how different assets perform under pressure. Safe haven assets like gold often attract attention when traditional equity markets become unpredictable. Gold's reputation as a store of value comes from centuries of use as a stable form of wealth preservation. When investor sentiment shifts towards safety, demand for gold can push prices higher across global commodity markets. Institutional investors often increase their commodity exposure during volatile periods to balance risk across their portfolios. This movement of capital from equities to defensive assets can temporarily reshape global financial markets. History shows that during times of war and uncertainty, markets react quickly and investors search for stability. Assets like gold and other safe havens often become the first destination for protecting wealth. But safe havens are only part of the story. In Part 2, we will explore the industries and companies that often benefit during global conflicts, including energy, defense, and cybersecurity. If you want to understand where capital flows during war, make sure you watch Part 2.